of recent enforcement in the marketing services space from the CFPB. As of a couple of years ago, they really started to investigate some marketing practices sort of throughout the mortgage industry and throughout the country. And so very recently, even as recently as about a week ago now today, there have been some enforcement actions, and so we thought that it would be a good idea to have a webinar and kind of go through some of the details as to why the CFPB decided to issue some enforcement actions on lenders and other related industry participants as of recently. So today I'm going to talk a little bit about marketing compliance in general, because some of the recent enforcement actions haven't just focused on marketing services agreements, but also just on marketing issues in general. So I'll go into some information about, what kind of marketing content issues can get you in trouble. I'll also talk about some specific considerations that you should think about when you're talking about joint marketing with, realtor or builder partners or title company partners. And then I will get into the specifics of some of the recent CFPB enforcement actions over the course of the last 2 months, focusing on the really recent CFPB enforcement actions and one HUD audit finding, which is interesting. And then I'll talk about some solutions for maintaining compliance with marketing services agreements and how to kind of avoid some of the pitfalls that have gotten some lenders and some mortgage industry participants in trouble as of recently. So some key marketing compliance issues to think about. The first thing is really, the content of the marketing itself. Obviously when we're talking about marketing content, you're always thinking about those Truth in Lending Act, trigger terms, but there's also some things that have been highlighted in some recent enforcement actions that you should be concerned about. In terms of using a current lender's name, I see this a lot in pre-qualification letters that are, used by gathering data from borrowers that are currently using other lenders. Sometimes if you mention the current lender's name in that pre-qualification, you need to be very clear that you're not associated with that lender, so there's specific additional disclosures if you're using a borrower lender's name and it's not your company. Additionally, we've seen them hone in on some of the Truth in Lending Act provisions regarding government endorsements. On websites, if you're doing USDA loans or VA loans, making clear that, any kind of, symbol, USDA symbol or symbol of the federal government doesn't mislead borrowers into thinking that you are associated or you are some sort of government agency. There's also a big push on UDAP as of recently, what we've seen with the CFPB. That's unfair, deceptive, abusive acts and practices rules. So in terms of the content that you're putting on websites or flyers, any kind of advertisement you're doing, whether or not you're doing it on a large scale through a marketing services agreement or a smaller scale just on one-off flyers, you want to make sure, or even websites, you want to make sure that any guarantees that you're making, like, we offer the lowest rates, best rates, are really substantiated. Otherwise, you run into a potential, misleading or deceptive representation, and they can fine you under UDAP. The federal government can bring a claim against you under UDAP. We see UDAP claims a lot of times kind of bundled into other claims. So, if they find an issue with an MSA or they find an issue with other FTC-related practices that you're violating, they'll bring UDAP as another way to, impose a consent order or enforcement action on you. So be careful about the guarantees that you're putting out there. Also, any kind of, company endorsements. As of recently, we saw that, if you're working with another company, or even sometimes consumers, if you're having any kind of endorsements made on your behalf, you need to be careful about whether or not those endorsements are actually representing, truly accurate representations of how your company is conducting business. There's additional FTC-related regulations regarding endorsements that the CFPB recently highlighted in one of its cases, which I'll get into a little bit more in a minute. But just generally, it's also good to think about those FTC regulations for advertisers. If you are advertising something, again, that's unsubstantiated through endorsements, whether those are consumer endorsements or the endorsement of another company that you're affiliated with, or another company that wants to affiliate themselves with you. You need to make sure that you're disclosing any kind of connections between your company and the person that's endorsing you. For example, in one of the recent consent orders, they were getting endorsements wherein a nonprofit organization was recommending the use of a particular lender. That recommendation was tied to some payments for that endorsement, and that wasn't properly disclosed, and therefore the CFPB found that that endorsement without proper disclosures to consumers was deceiving. So they find them under UDAP, and it was also a violation of the FTC's regulations. So important to think about that when you're thinking about just the actual content. Mortgage acts and practices rules also apply when you're thinking about content. Be careful, again, about misrepresentations. I often see branch team, kind of websites. Just be careful that, those team websites are properly managed, by your mortgage company. Or, if you are, the team leader, that you have all the proper representations about the company's affiliation with your team so that it doesn't look like you're misrepresenting that you're your own mortgage company to consumers, or that the team is its own mortgage company. And then there's also, a host of state-specific requirements, relating to, what state you're marketing in. States are very specific about the disclosure requirements that they want to see in marketing. So you'll want to think about some of these issues while you're actually drafting the content or reviewing content. There's also some additional considerations when you're talking about marketing that recent enforcement actions have highlighted relating to joint marketing. So, we'll talk about RESPA really in the context of marketing services agreements in a minute, but even just when you're doing any kind of joint marketing, the concept of RESPA still applies, that you are not supposed to be paying for referrals. So you can't give anything of value pursuant to agreement or an understanding for the referral of settlement business. So if you're thinking about, flyers or other types of advertising, lead generation services or websites that you're paying for, and that you're, sometimes paying for on behalf of a realtor, if you are going to co-market with a realtor or a builder or any other entity that's in a position to refer business to you, you'll just want to be careful that you're both contributing your fair market share for the cost of that advertisement. Because if you're giving something of value and you're receiving referrals, in return or in conjunction with that, it could be a violation of the Real Estate Settlement Procedures Act, Section 8. So you want to think about, when you're joint marketing, whether or not you're actually tracking, what's being paid for and by whom. It's also important to remember that you can't defray expenses for anyone. So when I'm talking about, those kind of leads agreements or website marketing agreements, if you are the mortgage lender and you're including a realtor in the services that you're seeking to get from a third party, you want somebody to manage a website for you or manage leads for you or something like that, and you're including realtors or other participants as part of that marketing on that website, you shouldn't be defraying the expenses that would normally be imposed on that other company for that type of marketing. So you should each be paying for your portion of the services. You also, of course, if you're joint marketing with an affiliated business, you want to make sure that you have the proper disclosures, letting borrowers know that you're affiliated with a business, you have a business interest in the other business that's making the referral to you, so that they have the proper information to make a decision about what settlement service provider they want. Again, when you're thinking about joint marketing, you want to be thinking about any kind of endorsements from an unfair deceptive acts and practices perspective that you're getting from any company that you're joint marketing with. And then with joint marketing, I also see a lot of Gramm-Leach-Bliley Act issues, so some information sharing issues. You want to make sure that you have the proper borrower consents before, or at least that you've given the borrower the opportunity to opt out of any kind of non-affiliated sharing of information with non-affiliated business partners that are for marketing purposes. So you'd want to make sure that your privacy policy that you're giving to your consumers has that proper opt-out. Otherwise, you could have a privacy issue as well. Okay, so getting into the recent enforcement actions with marketing services agreements. A lot of the other marketing considerations that I just mentioned are associated with these consent orders that we've recently seen. The main issue, though, that we see regulators having with marketing services agreements is when they're used in order to disguise referrals. And so they have been kind of keenly auditing and reviewing, the mortgage industry across the country. And that includes, vendors that are associated with marketing services agreements, realtors, builders, and mortgage companies and title companies. So it's kind of the entire industry. But we have seen the CFPB conducting kind of horizontal audits across the country on these as of at least a couple of years ago. And recently they've come out with some enforcement actions. That's not to say I definitely don't want to convey the message that marketing services agreements are in any way illegal. They're just that if they're used in order to circumvent payments for referrals, in order to circumvent that RESPA prohibition on kickbacks, then you really do have a problem and you violated RESPA. But there are certainly ways to do them wherein you can maintain compliance with RESPA. So I'm going to go through some of the pitfalls that we've seen from recent consent order examples. The general issue is that you can't give a thing or receive a thing of value in exchange for the referral of settlement service business. That's the main issue that the CFPB at least has kind of honed in on regarding these marketing services arrangements. So there has been a lot of recent enforcement. There was, the Lighthouse title consent order that came out in September of 2014. There was a Cornerstone HUD audit that had findings not just about Cornerstone violating RESPA, but also about realtors violating RESPA. That came out in September, again, of 2014, or it was published then. So they had findings and they recommended action based on those findings. Recently, there was a consent order for about $37.5 million in civil penalties and restitution, as of January of 2015, relating to marketing arrangements. And very recently, on February 10th, the CFPB came out with a consent order against NewDay Financial for marketing services agreement practices. So that was just about a week ago. So definitely something to pay attention to. So the basic premise of these marketing services agreements is that there's agreement between a lender, it can be a lender or a title company, any kind of settlement service provider, and a marketing partner, and that marketing partner has to be in a position to refer settlement service business to the lender or the title company or the broker or whoever it may be. So the basic premise is that you want to provide the lender or whoever the settlement service provider is with market exposure to that marketing partner's customers. That should really be the premise. So you want to think about, what the marketing opportunity is, and as you're thinking about setting up these marketing arrangements, that should be the leading issue that you're considering as you're setting compensation for marketing services agreements. Any payments should be commensurate to the marketing services that will actually be provided. The reason for that being that while RESPA doesn't allow payment for referrals, it does allow payment for actual services provided. So if you are paying someone to market your services, to put display racks in their offices, to put you on their website, to send out mailers, that's absolutely acceptable. However, you're going to have to keep documentation, and I'll talk about some of the compliance solutions in a minute, that you're paying for services that are actually performed. And that you're not basing the payments on the ability to get referral or business back to you. So RESPA prohibits, payment for unearned fees. So, there actually have to be marketing services that are being provided to you, tangible services. They can't be duplicative or nominal. And RESPA, will allow you to pay for those actual services provided. So I'm gonna go into each of the cases that I mentioned and kind of talk about some of the issues that the CFPB raised in their consent orders. So the Lighthouse title case, again, this came out in September of 2014. The CFPB fined this title company $200,000. The company had MSAs with brokers and other entities. And the main issue that the CFPB found with this was that the title company had set their MSA fees according to the number of loans referred. So it wasn't set based on actual services provided, but rather on the amount of business that they could get back. And they saw this through a pattern or practice. So the agreements themselves might have looked, in theory compliant, but when in reality they saw repeated payments that were related to the amount of business that was generated to Lighthouse Title, that evidenced that there was an agreement about a referral of business rather than for actual marketing services. Because if the marketing services remained the same throughout the course of the agreement, the fluctuation in payments would not have occurred. So you need to be careful about how you're setting your fees, how you're getting to that fair market value, and you need to have some sort of documentation of the valuation process and what the rationale is for paying this monthly marketing services agreement fee. So you should have some sort of documented negotiation and review for that fair market value. And sometimes it even makes sense to have an independent, non-interested third party provide you with some information about what the services that you're getting from this marketing partner would cost in the real world, so that you have someone that's disinterested in the transaction giving you that kind of information. You also should have some sort of policies and procedures for making pricing adjustments. So if you are going to adjust the fees on a monthly basis, you should have some sort of rationale. If you had it with a realtor and that realtor had 35 offices that they were going to be able to promote you at, and now the office that has your display racks and your brochures in it, 20 of those offices have closed, well, certainly you can adjust your fee that you're paying on a monthly basis, but you want to make sure that you have some sort of process and some sort of procedure in-house so that you are actually keeping documentation if you do choose to adjust a fee or terminate someone, so that it's unrelated to whether or not you got business from them or not, so that there's no tie to that and you have some sort of documentation that is unrelated to the referral of business, but rather because a real life event happened that changed how much you could value those marketing opportunities at. In Lighthouse Title, there was really no monitoring of the services rendered, so they weren't able to provide documentation that they paid a monthly fee for services. They had no documentation of the services that were provided on a monthly basis. So from experience working with companies that have been audited for their marketing services agreements, the CFPB is doing their due diligence before they knock on your door. So they are going to see if you have an MSA that says that you should be listed as a preferred lender on somebody's website. They're going to go and check that company's website before they come ask you whether or not you're on that company's website. So you should be monitoring on a monthly basis, that the services that you're paying for on a monthly basis are being provided, because they expect you to want to check to see that you're getting your money's worth. Additionally, and importantly in this consent order, the CFPB highlighted that there were other payments outside of just the monthly fees associated with the marketing services agreement. So there were other payments to a particular realtor that they had an MSA with above and beyond that monthly marketing fee. And again, there was no documentation to substantiate why they were making those other payments. They claimed that it was because of additional marketing services, but any payments outside of what's already in an MSA will be called into question. And especially if your volume is going up and there's additional payments being made to that realtor, you really want to be able to document that the additional payments you're making are not impacted at all by the referral of business, but rather because they're providing something to you outside of the referral of business. Some actual service is being provided for that. There was also, as I mentioned, a HUD audit in September of 2014, or at least HUD published their audit findings in September of 2014. And then what's interesting is that HUD got involved in a RESPA issue, a Section 8 violation issue with this, mortgage company. And the reason being that as they were reviewing, they were doing their regular HUD audit, the loans that were affected were FHA loans. So important to think about that if you get fined for, a RESPA issue, it can come up in a HUD audit and it can potentially cause issues with your HUD certification. It can cause you to have to provide indemnifications on some of those FHA loans. So it's more than just a civil monetary penalty from the CFPB. And HUD did recommend action against the mortgage company and also realtors that were involved. So this mortgage company was actually had MSAs with realtors. And both of them, the recommendation was made on both of them to take action. The issue with this particular, or at least what HUD honed in on with these particular MSAs in the results of this audit, is that there was exclusivity that was limiting the borrower's choice to choose a lender. The realtors were, in many cases, specifically forced to exclusively market the lender, and in some cases the realtor was not allowed to even have another lender come into their offices to conduct business. So not even necessarily a desk rental, but they weren't allowed to use the realtor. No other lender was allowed to use the realtor's offices to meet with their clients. The CFPB sees those exclusivity clauses in agreements, and also just in practice, from interviewing the realtors, any kind of forced exclusivity, they see it as limiting a borrower's choice and steering customers toward a particular lender. Even though in theory they can go to any lender, the CFPB, I can tell you from experience working on these, sees it as a red flag. This is the most recent of all of the consent orders. NewDay Financial here in the Maryland area was fined $2 million in civil money penalties that were paid to the CFPB for engaging in marketing services agreement practices that violated RESPA. This consent order also highlighted some of the UDAP concerns and some of the FTC endorsement concerns that I mentioned at the beginning of the presentation. So again, it's not just RESPA that they're thinking about, payment for referrals, but they're also thinking about, what is the marketing content? Is it deceptive? Are you misleading borrowers in any way? So this mortgage company was basically working with a nonprofit veterans association through a broker to have that nonprofit endorse and recommend that they use NewDay. And there were a number of issues that were highlighted in this consent order. I'll go into some of them. There was exclusivity wherein the nonprofit couldn't market anyone else except for NewDay. There were also direct marketing provisions which were problematic, where the CFPB doesn't like to see that any kind of marketing partner is directly marketing the services or steering customers towards the services of a particular lender. We've seen this come up in other contexts outside of this consent order, but what they, having display racks at the offices is fine, but any kind of provisions that actually require realtor agents, for example, to hand out a loan officer's business cards, that type of direct marketing where you're talking to borrowers that are specifically looking for, some type of loan or some type of financing, is problematic for them because they see it as steering. So, and in this particular case, there were endorsements of the marketing or of the lender specifically. So this nonprofit was actually in text in the advertisement recommending that they use this particular lender, and also making attestations about how great they are and why they were making these recommendations of this lender. There was an issue about UDAP here because the CFPB found that this was deceiving to customers because the referring party, this nonprofit, was referring customers and making these affirmative statements endorsing the company without actually providing additional information as to why there was a connection between the endorser, the nonprofit, and the lender. So the fact that the endorser was actually getting paid had something to do with the reason that they were obviously endorsing the lender. But instead of fully disclosing that to the consumer, what they ended up disclosing is that we've worked with this company for years, and all of these other affirmative endorsements, affirmative statements about the mortgage company, without actually making any kind of disclosure about what affected the endorsement. And the FTC actually has specific regulations about any kind of endorsements in advertising any kind of products. If there's anything that affects the weight or the credibility of the endorsement, so that it's something that would not be known to the general audience, that connection has to be fully disclosed. So this was not an affiliated business arrangement issue where they failed to disclose that they had some sort of business interest in the company, but even just under the FTC, the fact that you were under some sort of agreement with the company, even if you're not affiliated or there's not co-ownership, that was seen as a deceptive practice. I also think that the fact that the company that was making the endorsement to pre-screened customers or pre-screened members. This was a Veterans Association nonprofit, and so NewDay, a big part of their business was targeting these VA loans, and this nonprofit already had a targeted group of people that were members that they were endorsing this lender to. And so I think that that also led to the unfair deceptive acts and practices finding, because obviously there was a heavy incentive for someone that's a member of this group to go to someone that they recommended, especially because the endorsements were affirmative statements about their great experience with this particular lender. The CFPB also found that there were referral fees disguised as lead generation fees. So part of the payments that NewDay was making to this nonprofit some of them were for monthly marketing fees, and some of them were for lead generation fees. And as to the lead generation fees, I just wanted to make the point that lead generation fees are not the same thing, should not be the same thing as referral fees. In this case, they were. So there's a difference between purchasing leads and purchasing referrals. And the difference really being that in the past, obviously there's lead generation companies, and HUD even issued some statements a long time ago that purchasing leads is not problematic. But the reason for that is because the seller of leads is not affirmatively influencing consumers. You're just kind of handing off a list. In this case, obviously the company that was in the marketing services agreement and providing lead generation services to the lender was affirmatively influencing consumers, in that they were issuing endorsements and making affirmative statements about the lender. There was also a recent consent order in late January of this year, and this is the largest fine recently relating to a marketing services kickback scheme, where Wells Fargo and JP Morgan Chase, and also interestingly enough, particular loan officers that worked at Wells, were made to pay $37.5 million in penalties and redress to consumers. I'll also just kind of highlight here that note that in a lot of these consent orders that I've mentioned, there are penalties, civil money penalties. There's no necessary redress to consumers in a lot of these. In this one particularly there is, but it's important to note that RESPA is, if you violate it, you pay. It doesn't necessarily have to be that you've harmed consumers in any way. It's just the letter of the law, you violated it, and so you owe the CFPB civil money penalties, unfortunately. In this one, there was some redress to consumers associated with the payment of the $37.5 million. I believe about $11 million was given back to consumers due to this consent order. Also important to note that the loan officers not only had to pay individually for their participation in this kickback scheme, but they were also banned from participating in the mortgage industry. I get a lot of questions from mortgage lenders. Do loan officers have any particular responsibility? Are they individually liable? This goes to show that yes, they are. What happened with this, and the reason that they had to pay back all of this money, is that These companies, these lenders, some of the larger lenders are featured in this consent order. There was a lot of other lenders associated with this scheme. And they were working with a title company, and the title company was giving free marketing services to the mortgage company's loan officers in exchange for getting more title business. So they were offering them, leads. They were offering them, marketing, direct mail marketing services. And so, again, as I stated at the beginning of the presentation, giving or receiving a thing of value for referrals is prohibited. So the mortgage companies and the title company alike, violated RESPA here. So the mortgage companies were actually receiving something. Typically, we see consent orders against the people that are giving it, but here we saw that since they were receiving it, they were participating in the kickback scheme and even still violated RESPA. We should also note here that this is not just a typical MSA. This wasn't the product of, mortgage lender A partnering with realtor A for a monthly marketing service fee. This really was kind of using third-party marketing companies to disguise payments. So they were actually giving marketing services through other marketing companies. The title company was. The title company wasn't doing the marketing services themselves. But nonetheless, they were giving something free marketing services in exchange for referral, and so violated RESPA. One bright note to mention here on this consent order is that there were a lot of other lenders associated with this kickback scheme, quite a few actually, and a lot of them got out of enforcement action, that weren't Wells and J.P. Morgan because they self-reported that they were potentially involved in something they shouldn't have been involved in. They remediated the issue, and they cooperated with the CFPB in the investigation. So some hope that as long as you are trying to keep compliance with these, implementing policies and procedures to prevent any kind of RESPA kickback issues happening when you're involved in these marketing arrangements or marketing services agreements, that can definitely help you. And I've seen people result in no enforcement action just because of that. So just to summarize some of the red flags that we saw, from these particular consent orders that we talked about, and just a number of, private and government cases that are going on right now. The CFPB does not like to see direct marketing, as I mentioned, agents being required to hand out business cards or any kind of endorsements, so directly endorsing a particular, loan officer or lender. Also, exclusivity they don't like to see. They don't want to see that you're only allowed to, that the realtor or the builder is only allowed to market one particular company because they see it as limiting the borrower's choice in who they use or restricting it in some way. Also, you want to make sure that you have some sort of valuation for the fair market value of those services that are being provided to you. And if you have to make adjustments, you really want to make sure that the adjustments aren't frequent and aren't related to the referral business. So if you're going to make an adjustment, you have to have documentation that it's unrelated to referral, but there's some other justifiable reason for adjusting the fee. Frequent fee adjustments, though, are definitely a red flag for the CFPB. So you want to make sure that you have some sort of procedures in-house. So first, you want to make sure that you don't include any of these red flags in your actual agreements or in the practices that you're requiring of your marketing partner. But then you also want to make sure that you have some procedures in-house to make sure that you are, compliant in case you ever do get audited for these agreements. Make sure that you're maintaining compliance with RESPA. So you want to have some sort of negotiation and review process included in your procedures. That becomes important when you're talking about valuation and how you set the price. You want to have documentation of that. You want to make sure also that you are doing your due diligence on who you're getting into business with. So, we've seen sometimes on rare occasion that a builder might, do some sort of unlicensed origination activities. They actually start to talk about the loan, with the borrower. That type of thing, it elevates your risk profile. If there's some sort of complaint down the road by a consumer, and you are in a marketing arrangement with someone, even though your agreement states specifically that they don't have the right to talk to consumers about loans and that they should, that your company will handle any information about the loan. You want to be careful that you're actually just checking who you're doing business with, if they've been accused of any other consumer complaints, or if there's any unlicensed activity. It can definitely implicate you, because as I said, the CFPB does horizontal audits. So anyone that's involved with a particular marketing partner might get audited as a result. You also want to make sure that there's some sort of monthly monitoring procedures. As I mentioned, you want to make sure that you have documentation that you're paying, that you're getting your money's worth, so that you're paying for actual services. And that it's not necessarily tied to the referral activity that's coming from that marketing partner. So you want to have some sort of monthly marketing checklist to make sure that they've met their responsibilities as stated in the agreement on a monthly basis if you're giving them a payment on a monthly basis. You may want to have compliance approve that monthly marketing checklist to make sure that they've actually conducted the services that they said they were going to before you pay them, so that there's no issue about whether or not they did what they said they were going to do. Otherwise, why are you paying them? The implication would be that you're paying them for referrals rather than marketing services if you can't prove that. Also, you want to have some procedures about when you're making adjustments that you can substantiate the reason for the adjustments. Other considerations, I'll just quickly mention a couple of things that I see frequently associated with marketing services agreements. I get a lot of questions about desk rentals, and sometimes desk rentals are built into the services in the marketing services agreement. We've seen cases, both private and government consent orders related to not paying the fair market value of desk rentals. So the same thing stands in terms of fair market valuation for marketing services agreements. Just like you would value those services, you want to value the desk rental, that it's the fair market rate for rent in that particular area and the amount of space that you're getting, because anything in excess could be seen as a kickback. You also want to just consider privacy issues. Obviously you have an obligation if you're handling consumer data to keep it safely. And so if you have a desk rental in someone's office, you want to have some sort of information security procedures of your own that you impose on your loan officer that has that desk rental in the office. We've also gotten into a lot of state licensing issues with desk rentals. You want to make sure that if it's going to be considered somewhere where you're regularly doing business, you need to get it licensed, or in some cases just notify the state. That's a state-by-state specific issue, but it is something to consider if you're thinking about doing desk rentals. We've also gotten a lot of questions about agent MSAs and whether or not you can have a marketing services agreement with a particular realtor team or a particular realtor agent. I would say that you want to consider two things when you're thinking about entering into a marketing services agreement. I mentioned that the CFPB doesn't like direct marketing because they see it as the potential to steer. When you're dealing with a particular agent as opposed to an MSA with a company, I think that that particular agent that you're dealing with has much more of an incentive to steer customers to you. So you'll want to be careful of that. We wouldn't necessarily recommend that you, get into business with one particular agent unless you can, safeguard yourself against that steering issue. Also, you need to consider whether or not there's fair market value. How much are you going to pay this agent? How much marketing opportunity do you really have from a single agent? Or even a team. You just want to make sure that you're valuing the amount that you're paying that agent carefully, because anything in excess could be seen as a kickback. And so that's it for the presentation. And if you have any questions, feel free to email me. I'm happy to send this presentation around as well. I know there's probably a lot of particular questions about marketing services agreements now, especially because of all the late breaking news. And I'm happy to talk to any of you. Thank you very much, and have a good rest of the afternoon.